Simon Wallace, you are Global Co-Head of Real Estate Research and Strategy at DWS. Thank you very much for joining us on BiTV.
Thank you.
In 2020, commercial real estate markets have obviously been deeply affected by the COVID-19 pandemic. How is France's commercial real estate market faring compared to its European counterparts?
So it's a very good question. And the first thing I would mention is that particularly during a crisis, and particularly during this crisis, that data is in very short supply. So it is difficult for us to make comparisons between different markets, different European countries. But what I'd say from both the early sets of data that we're getting in and from our experience of our team on the ground in Paris and across other European cities is that so far we'd say that the French market has been a slight underperformer. So if I look at a few key metrics, if I look at, say, the office market in Paris and we look at vacancy rates there, what I'd say is that we've seen vacancy rates rise slightly more quickly in Paris than other European markets. But what I'd say also that Paris benefits from being a very low vacancy market coming into this downturn. If I look at the transaction market, transaction activity, first quarter of this year, French transaction activity, very, very strong. But going into the crisis, going into Q2 and Q3, it has again slightly underperformed the European average, not greatly, but slightly underperformed the European average. And we have also within some transactions started to see perhaps more of a price discount in Paris than perhaps what we're seeing in some of the major German markets. And bringing this all together, what we've seen, just some of the early data, if we look at the INREV fund level data, for example, Q2 in France, French-focused funds were underperforming the European core average over the second quarter. But again, let's remember, we're very early days in the crisis here.
Okay. And therefore, what is your forecast for the country's main asset classes going forward?
So I'd say overall, we're expecting, let's look at Europe. So overall, we're expecting to see the return of positive total returns in 2021. Initially, we think that's going to be led by yield compression. Certainly, the relative pricing of real estate today does look attractive when we compare it to, say, corporate bonds or perhaps the equity markets. And then as we go into 2022, as economic activity continues to accelerate, we're expecting to see the return of rental growth. If I look at the French market, for the office sector, what I say again, generally across Europe, we've downgraded our outlook, our medium-term outlook for the office sector, and that's reflecting increasing levels of working from home, for example, and just the tail impact of this crisis. However, in France, what we'd say is Paris is one of our outperforming markets over the next 5 years. We're certainly seeing a return of yield compression next year in the Paris office market. And given its low level of vacancy in certain sub-markets, we are expected to see stronger than average rental growth out of Paris. For the regional cities, we have less of a positive view. If we look at markets like Lille and Lyon, some of the vacancy rates there getting towards 10% plus in those markets where we have a less constructive outlook for those cities over the medium term. The logistics sector, logistics across Europe, again, certainly one of our best performers going forward. And interestingly, Paris is our top performing logistics market over the next 5 years in the whole of Europe. Certainly, we like Paris an awful lot for logistics. Strong e-commerce growth, very low levels of vacancy again in Paris, and with 12 million, 13 million potential customers to serve around Ile-de-France, very strong level of demand going forward there. Retail, quite the opposite with retail, unfortunately. Retail, going into this crisis, was very weak going into this crisis already across almost all European markets. And then with the impacts of the crisis and ongoing structural changes within the retail market, we're expecting something like a 20 to 25% fall in capital values in French shopping centres this year, and then continued value decline going into next year. So it's a very difficult picture for the shopping centre market.
Okay. And across Europe, are there maybe some countries or subsectors better positioned than others for the coming years?
Yeah, so in general, we'd say the core European markets is where we're expecting outperformance over the next 2 or 3 years. So that's the likes of the major German cities, it's France and Paris, it's the Benelux, it's the Nordics markets. And what we'd say in all cases there, that those countries, those markets have very solid fundamentals going into this downturn, very low levels of vacancy, tending to have limited supply pipelines. And also these markets are being seen as safe havens during these uncertain times. So we're seeing more core capital targeting these markets. Other markets that potentially look interesting at the moment, London and the UK at the moment, it does look relatively attractively priced at the moment. So when you look at the yield premium you're able to achieve in a city like London over Paris and Berlin, for example, there certainly is a pricing advantage of looking at London today. But clearly, we all know this, there is an elevated level of risk around the UK right now. So we have to certainly keep that in mind when we think about the UK market. At the sector level, certainly logistics. Logistics is one of our top performing market sectors at the moment, and particularly urban logistics at the moment, as we see growth in e-commerce spend and we see that increasing demand for delivery to home. Also, with competition for space for urban logistics facilities, we see very, very strong levels of rental growth for urban logistics. The other sector that we like an awful lot across Europe today is the residential sector. Residential, very well established in markets like Germany and the Netherlands, growing in other places like France and the UK. But we see that growth and that demand from institutional capital for residential only continuing to grow over the coming years. Residential has proved itself throughout this crisis of providing a very solid and stable level of income return during the cycle. And also, as we see more and more institutional capital, we could see further yield compression in that market. And again, we see growth and outperformance out of residential.
Great. Well, thank you very much for this insight. And thank you all for following us. See you soon on BiTV.